We have a quick question here from Alexander asking whether overall risk sentiment, whether it matters for medium or longer term positions like swing trades or position trades, and if so, how we can best approach it compared to just a shorter term intraday approach. So, thanks for the great question, Alexander. Let's start with the question on whether risk sentiment affects markets in the medium term. Now, the answer to that is absolutely yes, it does. And we only need to look back at some of the most recent recessions over the last couple of years for some good examples. If we look back at the devastation that risk of sentiment brought to the markets, back in February and March of this year, we saw a massive move to the downside on the back of the coronavirus threat to the economy as that started to get priced into the market. Another good example was going back all the way, and here you can see that thing, took a whole month to basically play out in risk of moves. Looking at the global financial crisis, another good example, even though it started at the end of '07, it took quite a while for the markets to price in, that recessionary fears, more than a year, really. So, very good examples that it can really have a more medium to longer term impact on the market, which is something to keep in mind. You can also look back at some of the past recessions where it was really a similar case. But the question, after this is, how can we approach this in our trading? So when can we know that it will have a longer and a more sustainable impact compared to when it might just be, something that impacts the markets for a few sessions? And it all comes back to the reasons for the risk sentiment, right? Whether it's part of a key macro theme in the markets at that time, or whether it's part of a lesser important, let's call it idiosyncratic driver that might be pushing risk assets higher or lower. Also keep in mind that even if something, is part of an overall important macro theme, it will affect every asset class differently depending on the individual drivers for those particular assets. So a good example of this is by looking at the Aussie versus the US dollar. So the Aussie versus the US dollar during 2018 and 2019 had a really, really tough time. And the reason why the currency pair suffered so much, of course, there was some broad-based dollar strength that attributed to a lot of that downside. But one of the key themes that drove the Aussie dollar lower was the ongoing US-China trade war that saw lots of downside for the Aussie dollar, which is very dependent on China for trade. Now, if we compare these moves that we've had in the Aussie versus the US dollar, let's mark those out with vertical lines. If we compare these moves with the same period for the S&P, we see an entirely different trajectory for the S&P. And the reason for that is that, even though the Aussie dollar is seen as a proxy for risk sentiment, you would have expected the Aussie dollar to follow something like the S&P a little bit more closely. But that wasn't the case. And the reason for that is that even though the trade war did pose a more shorter term setback for risk assets, I'm sure some of these blips to the downside was partly due to some of those trade war fears. Even though that affected the S&P, the overall trajectory was still moved to the upside due to the US economy just firing on all cylinders. We also just came out of the massive tax alleviation of tax break that some of the corporates got in the US. So that really gave a massive boost for growth. So we had both inflation as well as growth accelerating at the same time in the US, and that saw a lot of upside for the equities. Now, at the same time, like we said, you would have expected a little bit more upside for the Aussie from a risk sentiment point of view, with that moves to the upside that we saw in risk assets. And the reason why that wasn't the case is because that the Aussie dollar saw a lot of downside due to the trade war concerns and what that posed as a risk for the Australian economy. Now, among other things, of course, the dollar, like we said, during that time saw lots of upside as the US economy outperformed the rest of the world. And one of the key drivers for a higher dollar and lower major currencies versus the dollar was that while the Fed was busy hiking rates during this time, at the same time, we actually had other central banks like the RBA from Australia that were basically entering easing cycles as their economies were starting to slow. So, this example is a good illustration, just once again, like with most things in trading, it's never just one thing. It's always a combination of factors that we do need to keep in mind. And when it comes to risk sentiment, the important thing to keep in mind is, how it relates to swing or position trading biases really comes down to that specific asset class that you are trading, or that you're planning to trade, and what the fundamentals in the more medium and longer term are showing for that particular asset class, for the medium term as well as the longer term. So keep that in mind. Always keep in mind something like the equity and the Aussie dollar example, that just because the something like equities are expected to move up over the next let's say 6 to 12 months, doesn't mean that the Aussie dollar will automatically have to follow that. There might be other idiosyncratic factors driving the Aussie, or at the same time you might be seeing the Aussie dollar moving higher, but you might be seeing equities moving lower. It all depends on what particular fundamental bias holds bearing for that particular asset during that particular time horizon that you're looking at. So short answer is yes, it absolutely matters. Risk sentiment has a big bearing on the medium term, but it will affect every asset class slightly differently depending on the other factors and drivers for those particular assets over the same time horizon.